Economists are warning high interest rates could see Australia's economy drastically slow. Modelling from S&P Global shows the economy could contract to 1.2% next year, making it one of the worst performing in the Asia-Pacific region. S&P sliced half a percentage point from its forecast earlier this year due to fast and frequent interest rate rises. The agency predicting rates to rise to 4.6% in coming months. The agency is not alone with that forecast. Let's go to A&P Chief Economist Shane Oliver. Shane, good morning. Thanks for your time this morning. So S&P Global predicting that we're going to be one of the fifth worst performer in the Asia Pacific over the next couple of years. Is that entirely shocking to you?
No, not really. I think the reality is that Australia is very sensitive to rising interest rates because of the very high level of household debt. So far, we've managed to hold up okay, but I think that just reflects the hangover from the reopening of the economy and pent-up demand associated with that, and also the fact that a lot of people have so far been protected by being on fixed mortgage rates. But that's going to end, and I think we will see a sharp slowing in economic growth. S&P, of course, is talking about the next calendar year. Over the next financial year, we'll probably see growth dip well below 1%. And the risk is very, very high that will include a recession, probably starting, if it does, later this year or early next year.
So have you firmed on that belief, Shane?
I haven't. We're still 50-50 on it. If you look at leading indicators for Australia, they've fallen quite sharply, but they're not yet quite in recession territory. So that sort of leaves it open a little bit. But I'd have to say the risk of becoming increasingly skewed, and every interest rate hike by the RBA increases that risk. Like S&P Global, we are looking for the cash rate to go to 4.6%. That's a massive increase from where it was at 0.1% just over a year ago.
Yeah, it seems as though that's where we're heading, right? I mean, S&P Global's not alone there, like you just mentioned there, 4.6%. So we've got two more to go. We seem pretty fixed on that. Are you suggesting that, say we do get to 4.6, the chance of a recession becomes more and more likely?
Look, it certainly does. Look, we've got some inflation numbers out tomorrow, which might impact the Reserve Bank's thinking on these things. But I think in the last month or so, they've become a lot more worried about wages growth causing second-round effects and locking in higher inflation. So even if we do get the CPI coming down tomorrow, it won't necessarily stop the RBA hiking rates again. So that's the risk here. It's all about the consumer. Other parts of the economy are in somewhat better shape. But the household sector is very vulnerable to higher interest rates. Even the Reserve Bank has done analysis showing that 15% of people on a variable rate mortgage will face negative cash flow this year if the cash rate goes to 3.75%. And already we're way above that. So we are going to see a lot of stress in the household sector.
Okay, Shane, appreciate it. Thank you.